Yay. Thank you, Carly, for getting that started for me. Hey, everybody. We got 1 minute before 1:30, so I'll give everybody a second to see if we get more attendees. I'm happy to see that we've already got how many people? We got 9 people here. Cool. So, well, I'll just wait. So, oh no, it is 1:30 now, so I'll just start. Welcome. This is our once a month live with Caeli Q&A. You guys have seen the announcements and some of the emails that we've been sending. This is a quasi replacement to the bi-weekly live with Caeli, where I would come with topics and content that I would be speaking on. This is a way for you guys to ask whatever top of mind questions that you have about financing, about real estate investing, market conditions, whatever it is. And it's just an open dialogue between all of us. So I hope that you guys brought your questions. I'll do my very best to answer any and all that I can. In addition to this, we are sending out weekly, I believe, Carly, tell me if I'm wrong. I think it's at least weekly. Other things, just brain dumps for me, where, I've seen something or heard something, or I thought something would be useful to share. I'm going to record 2 minutes, 5 minutes, 20 minutes on whatever topic, and we're going to get it out to you guys. It'll be on our YouTube channel, and you guys will be notified what day of the week, Carly, are we sending those or trying to send those?
Yeah, so we're doing those every other week right now.
Okay.
They're going to be on Tuesdays. They'll be sent to you all via email at 1:30 p.m. Pacific on Tuesdays. And then, like Shaylee said, you can watch them on our YouTube channel. We'll have them on our podcast. So however you want to digest them, they're available for you.
Thank you, dear. And if you can't tell, I've got a heating pad here for my pinched nerve in my neck. I'm a piping hot mess. I gotta just tell you guys, I'm a piping hot mess. I've got knee surgery next week for an ACL, and my neck is so jacked up. If it doesn't correct between now and then, I'm in real trouble. So if I'm fiddling around in my seat, you know that I don't have a tick. I've got neck issues. I think the last one that I recorded, and I think it's gone out, or maybe it's going out, it was about self-employed income and how to navigate some of that. So for you self-employed people, if you're self-employed now, or you're thinking about becoming self-employed, I think there's some good content on that. Anyway, I have a few things that I would be happy to share having to do with the Fed and everybody's favorite topic, rates. They're meeting today and tomorrow. The Feds are for their, they have like 20 some meetings during the year. This meeting today and tomorrow is particularly interesting because they're going to include a summary of economic projections. So, and I think they do that twice a year, I think. Anyway, today and tomorrow, in addition to everything else that they're going to be discussing about inflation and where the Fed fund rate is, et cetera, they're going to have that content in there as well, which should greatly shape where we see interest rates go in the coming weeks and months. I believe my prediction originally is that the first rate cut was going to be sometime in June. I'm going to stick to that. I might err into July, maybe, we'll see. But I think even if it's July, my June prediction, I think is going to be close enough. I'm going to take the win. So I'll add a little bit more color to that. Well, actually, why don't I just do it now? I'm going to show you guys. If you guys are interested in rates and where they're going to go, I encourage you not to look at the headlines. You're not going to get what you need there. Okay. A lot of it's going to be wishful thinking, I think, in many cases. Secondary and Wall Street has a unique way of adding in color that may not necessarily be there for their own purposes. So I think it can be a little bit misleading. If you really want to know where interest rates are going to go, especially in this higher rate environment, listen to the Fed, man. So far, they have been ultra clear in what they're going to do, and they have not changed course. I have not seen them deliver anything other than what they've communicated to us. So my recommendation is watch the Fed, and I'm going to share my screen and show you guys something. This is how I look for it. And nothing that I tell you guys is novel to me. Okay, I'm getting the information just like you would from, well, these are the places that I'm going to be looking. Let's see if I'm sharing the right screen. Hold on, you guys. I think it's this one. All right, so you should see a web page here. This is federalreserve.gov. This is where I'm going to go to check out the minutes of the last meetings that the Feds have had. Let me tell you how I got here. So this is not the home page. So the home page is going to look like, this is the home page. So when you get here, you're going to look for monetary policy. You're going to look for meetings and calendars and information. Okay. And in this page, you're going to see all of the meetings, and you can go back years and years and read. So here's January's. This one isn't posted yet because it's ongoing right now. You can look at the statement. You can actually read exactly what they had to say and what that means. Now, if you guys need, and they're usually abbreviated, right? If you guys need help interpreting this, ask me. We're happy to discuss it and go over it kind of bullet point by bullet point. But this is very useful information, and this is where I go. Okay. The headline's fine. Try not to just read the headline, at least read the article. I'm sure there's going to be some bias in there somewhere. But like I said, if you guys want to know where interest rates are going to go or get a feel for when, what, how, why, where, listen to what Jerome Powell and his colleagues are saying. I'll have probably something to speak about this week related to today and tomorrow's meeting. It should be interesting. Overall, I can tell you right now what they're going to talk about. Inflation's still too high, right? Everybody knows that probably here today or listening in later, that their target inflation rate's 2%. Now, interestingly, just as a sidebar, I learned this week in doing a little of my own investigatory work, that 2% is kind of a fugazi. They just came up with it. It's only been around since 2012. It came from New Zealand, actually, in the 90s, when inflation was kind of out of control. Their economy and lots of European countries, their economy was really, really running hot on inflation. And it was New Zealand's president at the time that came up with a 2% inflationary rate. Okay, that was in the 90s. So fast forward, and it got some traction, but it wasn't until Ben Bernanke, who was the Fed chair at the time, looking back, came up and adopted what they had said all those years before. And it was 2012 when that happened. So in this country, the inflationary rate, that level, that 2% that we've been fixated on in the last 2 years, is barely a decade old. I assumed, because I had asked the question multiple times, over since March of 22, I think it was, when the rates started to really increase because of the pandemic, et cetera, et cetera. I started to ask the question, where's this 2% coming from? What is this? I assumed that it was bedrock. It was foundation of where our country came from. And I was expecting to get some evidence of that. And I couldn't find anything. And just this week, I did a little bit more digging and learned that it's a byproduct of something that New Zealand came up with in the 90s. So I was very surprised to hear that. So it's not policy, it's something else. And I wonder if, as a result of that, it's not fluid enough to accommodate all of the nuance and the variables that go into what inflation rate needs to be or should be. It seems rather rigid to me, given where it came from and how steadfast and staunch they are about it. So I'm a little bit worried about that. I guess I'm going off on a tangent. In any case, here's what you guys are going to get out of it. If you go to the minutes, if you go to this on Thursday, all of the information will be there. You'll be able to read through what happened. I don't expect that Jerome's going to report that we're reducing the Fed fund this time. He's going to hold up until this week. A lot of people expected them. I think they may even said this, that they're expecting 3 rate cuts this year in 24. I'm reading that they think now, because inflation is still 3.2%, it's still on the high end, that they may limit that to 2 rate cuts this year. So that's not going to bode great for our purposes necessarily. But you guys know how I feel about rate. Maybe I'll talk about that in a second. In any event, the point that I'm trying to make, if I could just get to the point, is that by all metric, PCE, CPI, jobs report, all of these different things that are going to be considered when looking at a forecast for inflation. Because remember, there's a lag. There's a lot of things that are happening that are real time now, but they're not going to have the data to support whatever move they're going to make until 30 days, 60 days, 90 days, 6 months down the road. So that lag is important. But the metrics that they're looking at today, they're too hot. The economy is too strong. And the stronger our economy, what happens to rates? What do we think is the result of our long-term bond rates that our mortgages are tied to? What do we think about rates if the economy is super hot or super strong? Up. They're not coming down until they crack that code, that 2%. I'm going to do some more research on that too and see if I can't figure out why Bernanke came up with that as kind of a place card, and why we're so devout to that number now out of, I don't know. All right, am I just talking to hear myself talk? Is any of this useful information? This live Q&A thing, it's supposed to be you guys asking me questions, and I haven't shut up once.
We do have
Okay.
one question already,
Okay,
Caeli. You want to go
let's
for it?
go. Yeah, let's go.
All right, Teresa, thank you so much for your question. She says, Real Estate Moron 101, that's me. Question. Does the annual household income threshold to qualify for single family home purchased by state or duplex or a fourplex apply to real estate investors or only to first-time home buyers?
Only first-time home buyers, and more often, Teresa, and absolutely, that is not a dumb question. Moronic is far from what I would say there, and there's really no dumb question when we talk about financing and investing, etc. I think what you're talking about more is applicable to USDA loans. That's usually where we're going to be looking at the household income in relation to the loan product, and there are caps and maximums and minimums that you have to hit based on how many people are in the household, etc. In any case, no, that will have no bearing on non-owner occupied or investment type financing, conventionally or otherwise. Good question, though. What else you guys got? Anybody want to talk about my pinched nerve? I'm dying over here, man. It's can I, how many Advil can I take in a day? Is 20 too many? I'm kidding. I'm teasing.
You're also welcome to unmute yourselves if you want to just ask a question out loud. You can go that route. You can go the chat, the question and answer, whatever you're comfortable with.
Yeah, can I go ahead and shoot one? I keep hearing about these golden tickets, the Fannie and Freddie tickets. How can you check if you have used one of those previously? Because I bought a house previously, and I've also refinanced it before, and I don't know like how to check if those end up bundling into the golden ticket path or not.
Yeah, that's a good question, Derek. Thank you for engaging. So there, and this happens a lot. I hear this a lot. So you are under a misinterpretation of what the rule is. So the golden tickets are not 10 over your lifetime. It's 10 currently. And the way in which that's going to be defined is any residential property. So single family up to 4 unit, 5 units and above is commercial, and they will never count. So residential property that has a loan on it that is either in your individual name or personally guaranteed by you. And this is an important distinction. A lot of times investors will have gotten a commercial loan, okay, where the loan itself was written to the LLC or the entity. So the loan and title, both of those closed in the LLC name. The individual just assumes it's a commercial loan. This is not showing up on my credit report. It's not going to count against my golden 10. But in the event that that person signed a personal guarantee on that loan, that's called a recourse commercial loan. Fannie Freddie says that if it's a residential property with a personal guarantee, it will count against the 10. So let's say that you had a cross-collateralization commercial loan, and there's 6 loans inside this one blanket commercial loan. You have signed a personal guarantee. That's called a recourse commercial loan. All 6 of those will count against your golden tickets. But I think to your point, let's say that you had 7 loans in the past that no longer exist anymore. Those are not taking up golden ticket spots. It's real-time current right now. Any residential property that has an existing loan on it in your name or personally guaranteed by you. Was that your question?
That was, yes. And I kind of have a follow-up, but I'll let I don't want to interrupt on the question in
No,
the chat.
we're on a roll. Let's go for it. So that was good news for you, right? You realized that what maybe you had thought, those don't count, just only real time today is and it can overturn itself. So as a real quickly, Derek, as a function of strategy, let's say you've maximized the 10 right now. You've got all 10 golden tickets used, and you've had them for some time. We may actually look at your portfolio and say, okay, these 6 of the 10, they've stabilized. They look really good. Let's look at putting those into a cross-collateralization commercial loan, non-recourse. Non-recourse is there's no personal guarantee. So I've just taken those 6 and removed them from the 10. Now you've got 10 new spots. So that might be an ongoing conversation of strategy that we would have, after a period of time. Anyway, sorry, what was your follow-up question?
Yeah, the follow-up kind of relates to that personal liability factor. If you go ahead and you'd like to have an LLC around these mortgages or the deeds to the houses, I'm assuming that rules out the possibility of a golden ticket because it's no longer in your individual name.
So first of all, the distinctions, I think what you're asking, so you have the loan and you have title, okay? The LLC, chances are your desire to have the LLC as a part of that conversation is for asset protection, right? Okay. If it's for asset protection, the loan itself should be in your individual name, and then you should close in the LLC name for title or execute a quit claim deed, QUIT, quit claim deed into the LLC right after. Now, if some of you are listening to this and you're concerned about, well, what about the due on sale clause, right? If it's a conventional loan and the due on sale clause, that's old school thinking and guidelines. So 2016, Fannie Freddie came out with updated guides that say you can absolutely hold these properties in an LLC so long as you, the borrower, the one that's obligated to the debt, is the majority owner of the LLC. So if you close in your name, the loan and title, and you want to put it into your LLC for asset protection, you'll do that the day after you close because Fannie won't let you close in the LLC name. You'll quit claim or warranty deed, depending on the state, that's what they're going to have you do. Put it into the LLC. As long as you have the majority ownership, you're fine. If it's a 50-50 between you and a spouse, I'm going to say you're fine there too. If the LLC is you and a partner and you have 49.9 and the other individual has 50.1, that could be problematic based on the rules that are written in the event of default. If you default on the loan and that were to come up, you probably will have an issue. Otherwise, I don't know how that would come up. But anyway, that's the rule for asset protection. Now, this goes down some rabbit holes. You guys know how much I like my rabbit holes. I just want to give you a schematic of the different loan products and how the LLC piece works and what counts against the golden tickets and what doesn't. And I'm going to start with the most favorable terms, and I'm going to work all the way up into the least attractive or least favorable terms. Fannie Freddie are the best rates and terms, golden ticket, right? You must close the loan and title. I said a second ago, I differentiated between the loan and title are two different things. You can close, in some cases, the loan in your name and title in an LLC name. I'll get to that in a second. Some cases, it's going to be both names, individual is how you close. And then some are going to be both in the LLC as you close. Okay, so follow me along this trajectory. So Fannie Freddie, both the loan and title are going to close in your name. You can transfer title ownership the next day into the LLC so long as you hold majority in the LLC. Okay, then we move into non-QM products. Non-QM products are, all right, let me back up. QM stands for qualified mortgage. Fannie Mae and Freddie Mac are the epitome, the actual definition of what a qualified mortgage is. For those of you that remember 2008, 2009, you've heard the term Dodd-Frank. Those are the last names of the individuals that wrote the sweeping legislation that affected all sectors of finance after, the housing and lending crash. Anyway, within that, as related to mortgage, Dodd-Frank tells us about ability to repay, ATR, and QM, qualified mortgage. I won't go into the rules of what those mean, but conventionally, Fannie, Freddie, FHA, VA, those are qualified mortgages. Everything outside of that box is now non-QM. Okay, within non-QM, it's not just for investors, it's for anybody that can't fit inside those conventional loan products. For investor purposes, the products that would be applicable to us are going to be debt service coverage ratio, can be found in non-QM, bank statement loans, asset depletion loans. Like if you had $1 million in some brokerage account, we can come up with a formula to get a number of income to help offset your liabilities. So those are the ones that will be most applicable to investors in non-QM. Non-QM is still a 30-year fixed mortgage, relatively similar in many ways to a conventional. The rates are going to be higher. It's higher risk. For whatever reason, you can't fit into those boxes. Maybe you've exhausted your 10 golden tickets, right? You can't get any more Fannie Freddie, so now you're going to go into the non-QM sector because there is no limit there, right? It could be a variety of reasons that you found yourself in the non-QM space. In non-QM for investment, the loan will always be in your individual name, but you can close title in the LLC name at the closing table. You don't have to go into a quit claim deed or warranty deed after the fact. I guess that's going to be the primary difference as we're talking about the LLC component of all this. So Fannie Freddie, loan and title close in the individual name. Non-QM, loan closes in the individual name. Title can close in the entity name if you choose to do that. Now we move into commercial. And a minute ago, we talked about recourse and non-recourse. And I said I was going to take it in the same trajectory as best to worse. Recourse, you're signing a personal guarantee. You've got skin in the game. Those terms are going to be a little bit better. Loan and title close in the entity name. Non-recourse commercial, loan and title close in the entity name. But the terms on non-recourse are going to be pretty harsh. And I'll tell you guys, when we talk about recourse and non-recourse, a lot of people come to me and think that they want non-recourse. No, you don't. Unless you're a developer or you've got a 100, 200 unit apartment building complex that's being built or whatever, you don't need a non-recourse loan. And here's why. Let's just say that you're just dead set on closing the loan and title in the LLC, and you absolutely want that commercial loan product. I'm going to disagree with you and we'll talk it through, and then you guys make the informed decision. We'll do what you want. We have all the products anyway. But just for a minute, let's just say for sure we're going to go commercial. Probably not, but for my conversation, we're going to say we're going to go commercial. The personal guarantee, I've been at this for 25 years. Okay. I have yet to see a lender in the event of default go after the individual on a recourse loan where they signed a personal guarantee. They just want the property back. The only exception to that comment could be if the property was in such horrific disrepair and that their losses were going to be staggering. Under those characteristics with a personal guarantee, sure, it's likely that you personally will be attached for those losses. Otherwise, they just want the property. And it means that you've defaulted, right? So you've got bigger problems anyway. So recourse, non-recourse, I would say that definitely the recourse of that is really the same as looking at a DSCR, right? Except for the differences. This is not going to show up on your credit report, the recourse commercial. The DSCR loan, because it's in your individual name, will show up on your credit report. Then the next question I get in line with that says, well, I don't want it on my credit report. It's going to be harder to qualify later. No. So when you're looking to qualify for most reasons, nobody cares about the overall debt. Now, there may be some credit unions that pay closer attention to that. That's fair. But more often than not, it's not about the overall debt that you owe. It's the monthly payment of that debt that they care about. And that monthly debt has what to offset it when we're talking about investment properties. We have income, right? So if you're doing it right and you're working with Ridge and we're giving you the appropriate advice and strategy and structure, it's actually going to make you look better in the debt to income ratio department than it would otherwise. So hopefully I'm not taking you too far around the horn to get to the point. I think that commercial loans have a place. Forget about non-recourse, unless I said you're looking at 100-unit apartment complexes. If you have to go commercial, keep in mind, even on a recourse basis, the loan minimums on commercial are going to be far greater than what they would be on the other product lines. Generally, to get anywhere decent loan terms, you want $500,000 and above on a commercial loan. When you start getting below that, rates get kind of high. 250 and below is very difficult to find. So if you're looking at a residential property and the purchase price is 200 grand with 25% down, you're gonna have a real hard time finding a commercial loan to begin with, let alone recourse versus non-recourse. Derek, how did I do? Is there outstanding questions in that? I think I went overboard, but good. Okay. All right.
Perfect. We have another question here from Emily. What are the current residential HELOC rates your clients are seeing, and do we offer an all-in-one?
Who asked that question?
Emily.
Nice, Emily. Yes, we have the all-in-one. We have, and that's a first lien HELOC. I'll get to rates in a second. And we have second lien HELOCs for investment properties and primary residence as well. So we have first lien and second lien. If any of you have heard me speak in the past, you know I am a massive fan of the all-in-one. It doesn't work for everybody. I recognize that, but when it does work, especially for real estate investors, I do not believe honestly that there is another loan product to rival it. Just don't think that there is. It's a mechanic that turns you into your own bank. And in terms of interest paid, you can greatly diminish the amount of interest that you will pay on an open-ended revolving line of credit like the all-in-one versus a closed-ended fixed rate mortgage, where the interest rate may be lower, but that's not the math that you should be looking at. And I'll do a deep dive into that. I love that loan product. The fully indexed for the all-in-one right now is 9%. The index is the 1-year CMT. That's the US Treasury. It's currently posting at 5%. That was as of March 1st. We'll see what happens April 1st. It can change up to once per month. and then we add it to a margin of 4%. So the fully indexed is 9%. The life cap on that loan is 6% over the initial fully indexed rate. So if we were closing the all-in-one in March, we know that that's 9% this month plus 6%. So the life cap would be 15% on the all-in-one, which is quite a bit lower than most second lien HELOCs. If you guys are familiar with HELOCs, you know that most of them in second lien position run a life cap of 18 to 25%. So the all-in-one has a little bit of an advantage in the overall life cap, meaning that no matter what happens with the index, the variable part that can move, the rate can never ever exceed 6% over the initial fully indexed rate, which in the month of March would be 15%. I think I said all that right. The second lien, well, let me see. This might be fun. Am I still sharing screen? No, good. Okay. Let me, let's go. I'm going to show you guys something else. So let's talk about second lien HELOCs. And the investor that we use for that, oops. Shit, hold on, guys. The investor that we use for that is a place called Spring EQ. And we have access to an easy, quick pricer. This is kind of cool. So if you guys needed a quote, we can get it done pretty quickly for you. I'm just going to kind of share some insider information. I'm just going to make up some numbers, okay? I don't know. It doesn't really matter. 70% CLTV is applicable for our second lien HELOCs on a rental property. Oops. So what I've done here is I'm saying that this property is worth 500,000. We're requesting a line amount of 250 and we owe 50,000 on the first lien mortgage. Okay, I'm just making it up. I'm at 60% CLTV. So in this example, I'm 10% short of what I could actually get, which I would never do it this way. I just threw some numbers in there. I'm always going to say that if you have access to 70% CLTV, take it, man. You're never going to pay interest on anything that you're not using. There is zero reason not to take the full line limit if you can qualify for it. So this is not a great, here, let me just change it so that my example is not stupid. Let's say 500, I can't do mental math, 500,000 times 70%. So 350 is what this should be. No, I did that wrong. I swear I put 70, maybe I put 80. I thought that looked kind of high. Oh, they're saying, okay, that's what I did. Sorry. These two are added together. So I'm requesting 300,000 as the line limit because I owe 350. These two numbers added together, 350 divided by the value of 500,000 gives me the 70% CLTV, combined loan to value. Okay, and LTV is just the first lien divided by the value. When you add the first lien and the second lien together and divide it by the value, that gives you your combined loan to value. Property is going to be Arizona. We're going to take the full 300,000, doesn't matter. Credit score 780 and above. You guys can all see this, right? Okay. DTI 43% or less. You can see we can go higher than that, but for our purposes, I'm just pricing this out for you guys. Borrower paid. I think it's 2.5 points as we charge for this. Oh shit, I did that wrong. Okay. We're going to go investment property. It's a single family, not a flood zone. No. Okay. And then it should tell us what the rate would be for this scenario. If you guys have scenarios you want us to run, just let us know, please. So there's a HE loan option, by the way. This is a fixed second lien. It's just like your first lien. It's in second lien position and it's a 30-year fixed. Okay. I don't like this option. The only reason that you would take this option is for whatever reason, you can't qualify for the HELOC option. Maybe there could be circumstances. I won't go into all of that, but you could do this. We do have, and this goes to 80 or 85%. I can't remember on the HE loan fixed 30-year second lien mortgage. This is the guy that we want. This is a HELOC with a 3-year draw. It's 10 years interest only, and then a 20-year repay. Okay. Interest rate, given the variables that we have here, would be 11.25 is what you can expect. Again, 3 years. Now, this is fine. But let me go back to the all-in-one. The all-in-one is a 30-year HELOC, you guys. 30 years you have access to that line of credit. What happens is that for the first 10 years, it goes unchanged. In month 1 of year 11, the credit limit will start to reduce extremely slowly by 1/240th%. Where does that number come from? Well, 240 is the equivalent of the remaining 20 years in months. So if I took 20 times 12, that's how you get 240. Because I just said we take the first 10 years unchanged interest only, and then in month 1 of year 11, the line limit, the credit limit will reduce by 1/240th%, and it's going to do that every single month for the last 20 years. So the easy math example I give in that case, just to kind of demonstrate, let's say that the limit you started with was $100,000. Okay. The first month of year 11, it's going to go down by 1/240th or $240, right? So instead of the limit being 100,000 now, the limit is now 99,760. Do you guys see how I got to that math? I just took $240 off of 100,000 by 1/240th. So now my limit is 99,760. And because on any HELOC, not just the all-in-one, on any HELOC, the balance can never exceed the limit. You can't have more in the balance than what your credit limit is. That's how repayment works. So unless the line was totally capped out in that first month of year 11, right, the payment that you'd have to make in that case, the deposit you'd have to make would be $240 to keep it at the same line going down. And that's how repayment on the all-in-one works. But it's still a 30-year access, which is kind of cool. Anyway, okay, enough about that. Did that answer your question, Teresa? Who, I don't know who asked that, sorry.
Oh, that was Emily.
Sorry, Emily.
Yeah,
No,
thank you. I mean, I think my question, just to follow up, if you don't mind, with the
Yeah.
all-in-one, I'm a TARDIS person,
Cool.
referral, and if we weren't going to be starting with investing in property, but other forms of investments, would this be a product we would be able to utilize for that sort of thing?
Yeah, absolutely. I mean, and that's the other cool thing about we're still talking about the all-in-one. That's the other cool thing is that, you know, it's your line of credit. I think I started off by saying you've turned yourself into your own bank. You get to use it when you want, for what you want, how you want. There's no pre-qualification every time you want to access it. You're not having to refinance every time you want to harvest equity, right? You're not having to go through that process and pay the closing costs again and again and again. It's your line of credit for that amount of time. When you pay it down, you charge it up. You're not asking permission for, can I use it for this or that, or is it allowed for whatever? It's totally at your discretion.
Thank you.
You're welcome. What else, guys?
Next we have Tanya, which you might have possibly answered some of this question here, Caeli, but she asked, looking to purchase an investment property with a hard money loan and would love to refinance into an all-in-one loan. Will this be a good option?
Sure, if the numbers work. And what we can do, and you guys, I'm sorry, I gotta have Vonna bring me my ice pack. I'm freaking dying over here. Sorry, guys. Okay, refinancing from a hard money loan into an all-in-one, right? That was the question.
Yes.
Okay.
Refinance from hard money to all-in-one. Yes.
Yeah, 100%. If the numbers make sense, they make sense. And the cool thing about the all-in-one is I'm going to share screen again. Carly, you'll have to shut me off again. The cool thing is that we have a simulator. For those of you that have not seen this, this is going to be super cool. And this is on our website. Okay, so you don't have to remember it here. But within the confines of this simulator, you are going to be able to compare, say, refinance. Let's just go, you said a hard money loan. I'm just going to throw some numbers in here to an existing loan. You'll be able to throw the variables in here and compare it. Actually, maybe, yeah, you want to compare it to a new loan. So if you were choosing between the all-in-one or a 30-year fix to get out of your current hard money loan, this simulator will allow you to do that, and it'll show you in real time what the differences are. Thank you. Hot mess. I told you guys I'm just a hot mess. Oh God, that hurts. So yeah, I think that sorry if that's noisy, you guys. If the numbers work, the simulator will tell you for sure if the 30-year fix that you could get over here at 7% or whatever it is versus the all-in-one makes sense for your scenario. It'll be real clear on the results page, and there's no vials of blood or DNA samples here. It's pretty straightforward input. I like to do these really one-on-one on a Teams call, like a video call like this, with my clients to make sure that, one, they're interpreting what the fields are asking, because sometimes there may be some confusion about what it's really asking you. So I'll be there to interpret that. And then finally on the results page, I can decode any of because there's some technical stuff on the results page, maybe more data than you need, that I'll be on hand to answer questions about too. So yes, the all-in-one to replace hard money. Yes, yes, and yes. Are you the right candidate? I don't know yet.
Awesome. So we have one here from Tyson now. He says he bought a car with a partner in an LLC, or sorry, a car wash. They renovated it, but are just beginning to collect income, so no profits yet. They used hard money loan, but looking to cash out refinance. Do you have a loan product that would work for this?
How long have you had when did you purchase it, sir? You can unmute if you want.
Yeah, just last July.
And it's stabilized and you can show, probably not rent rolls, but you'll be able to show profitability statements and where it's headed and where it's at.
Well,
There's
that's
no,
the
there's no
problem. We
income at
don't-
all yet.
yeah, we're just getting some quarters of the backs, and we're just getting the other stuff up and running, all new equipment and everything.
Yeah, on a cash out basis, you're probably going to need to show some financials. I'd say you probably need to take it through the rest of this year. You know, Tyson, feel free to email me and I can do a little bit more fact finding on the commercial side. Pauline Hines usually handles most of our commercials. She may have a different answer than I do, so I'd want to just double check that and not assume. But my anticipation is that we're going to need something maybe through the remainder of this year before you can pull cash out. Is there a loan on there's a loan on it now, right?
Yeah, I got a promissory note from a private investor. With it.
Email me, Tyson, cridge@ridgelendinggroup.com, and let's just go over a little bit more discovery and I'll try to get you a real answer.
Okay, thank you.
Yeah.
Perfect. And now Amber asks, could you speak more on the products that we have for developers?
Ground up construction, Amber, is that what we're talking about?
Yes, single family new construction.
Yeah, so we've got a few options for that. Pauline handles a lot of that for us as well. It needs to be shovel ready. I can tell you that. Experience is going to be a big deal on new construction for investors. If this is your first time, you're probably going to need to get some kind of a signature or co-signer that has some background experience. You know, the funny thing about the commercial and kind of ground up construction, they want to see experience, right? Funding the investors that we're going to work with to fund those, they want to see that the individual has experience. But how do you get experience if you can't get the loans, right? It's kind of this double-edged sword. We have them shovel ready. Does everybody know what shovel ready means? I'll just shovel ready means that all the city planning is done. They've got plumbing and the electrical and street lights and sidewalks, and so all of that has already been ready to rock, and we're ready to start breaking ground to build the structure that's going on that piece of land. What else about that, Amber? Did you have any other specific questions? I'll try to answer.
I guess it's infill development, and specifically we received a grant from the city to do this project. It's just one of those situations where you have to do it before they pay you the money. So I was just curious, products wise, I know that's not how lending works, which again, like you were saying, it's chicken or the egg.
Right.
So I was just curious, like where to start to look to see if something like what we have coming up would qualify for some of the products that you guys have.
You know, if you have the grant and everything's, it's from the city or the county or whatever, chances are you'll be able to use that as a credit. I think that this will be a little bit outside my wheelhouse. I'd like to get Pauline or Justin involved. If you want to, another one, email me directly and we'll see if we can get you some more tangible answers. That's where I would leave that answer. Did you get my
Okay.
email address? You want me to spit it out again?
I'll add it to the chat as
Okay,
well.
thanks,
Yeah.
thanks, Carly. Ridge
Yeah,
at
of course.
ridgelendinggroup.com team.
Thank you so much.
Yeah, thanks for the question, Amber. What else, guys?
All right. So, Amber, to answer your other question too, yes, we do lend in Louisiana. The only states that we do not are New York and North Dakota. So we're everywhere else. And then, let's see, we have a question here from Bruce, and I think that you answered this one earlier, Caeli, but I just want to make sure. So he asks, when does the term of an all-in-one mortgage end or expire? Is the line of credit open for 10, 20, 30 years? So
Yeah, just to recap, thank you, Bruce. How are you? It's a 30-year HELOC, which is very unique. If anybody has any experience with HELOCs, it's 2 years, 3 years, maybe 10 years. I don't know of any other HELOCs that let you go the full 30. So this is a 30-year HELOC where you actually have access for the full 30. What happens is that in the last 20 years of the term, the limit will start to decline or reduce very, very, very slowly And because on any HELOC, you cannot owe more, the balance of what you owe cannot exceed what the credit limit is. That's how repayment works. The balance or the limit starts to decline over the last 240 months.
Perfect. And Xavier asked, so after 30 years, if you're doing the all-in-one, would you just refinance it into a new all-in-one with a new rate?
I would, but here's the thing, guys. The chances of you having that line of credit for 30 years is little to none. Okay. The shelf life of a non-owner occupied mortgage. Now, an all-in-one, I might argue, would be a little bit higher than this, but a traditional mortgage for investors, the shelf life is about 5 years. Okay, before you're selling it for a 1031 exchange, before you're refinancing it to harvest equity. Now, if you're refinancing to harvest equity, it's unlikely you're going to need to do that with the all-in-one, unless one difference there is going to be, sorry guys, one exception to that would be if the value has gone up considerably, right? And you want to get in or get at the rest of that equity. So let's say that you started with a line limit of 100 grand, but in 6-7 years time, you now have access to 200,000 as a line limit because the value has gone up so much. There may be some incentive to refinance into a new all-in-one if your circumstances are the same, similar, or better, to get access to more capital. Otherwise, I guess, yeah, if it stays, if the value stays the same and you just want to keep that for the full 30 years, yeah, refinance into a new all-in-one or line of credit. Yeah.
Perfect. So Jeffrey, we have a question. He says he has some questions about the all-in-one on a new loan that he has. So Jeffrey, if you want to unmute, feel free to. See.
Where are you at, Jeffrey? Jeffrey Colgate?
Yes, Jeffrey Colgate.
Hey, Jeff.
While he is getting on there, we can move on to another question we have here from Kelly. For the all-in-one, is the LTV still 70% for investment properties?
Yes, good question, Kelly. Max LTV purchase or rate and term or cash out refi is capped at 70% for non-owner occupied, 80% for second home, and owner occupied is the allowable LTV. I think on an owner occupied, we can actually go to 90% on a new purchase. I want to say there is PMI, but heck, it probably makes sense. The higher the limit, I think probably the better. But yeah, 70% max on investment.
Perfect. All righty. And Jeffrey, he let me know that he was not having success unmuting himself. So I've just asked him to unmute here and hopefully we can get that on there. Get that going.
And we have too, you guys, as Carly's looking through that, we have, I'll share screen again. And I think, Carly, please tell me if this is correct. It should be, where am I going to go? Desktop. We should have this on our community page. Where's the all-in-one? Here we go. So you guys have access to this, or you should have access. This should be on the community page. So if you want to check this out, this will give you a sense of what's required and what's not. So here's the program highlights. So it's available in all states except for owner occupied in Texas is not allowed. If anybody here lives in Texas, start writing to your congressmen or women and saying, what in the hell with these outdated laws? I don't know why Texas is so weird about owner occupied and lines of credit. You got your qualifying, max, credit score, reserve requirements, property type allowances, occupancies. If you have a line limit over $1 million, you're gonna need 2 appraisals. Gives you some other LTV limits here, number of finance properties, et cetera, et cetera. So useful information. It's on our community, right, Carly?
Yeah, and I'll repost it there for you all so it's easy to find.
You know what else should be on there in addition to this, if you want, if for anybody that's listening to this, since we're talking about the all-in-one, check this out. This should be on there too. Let's share again. I'm all about sharing today. This is our FAQ. It's like 6 pages long. There is a ton of useful information on here, you guys, that most of the questions that you're going to be asking me, which they're welcome always, you're going to find here. If you can't reach me quickly, you want answers faster than I can get to them, whatever it is, chances are your question will be answered within the Q&A of this FAQ sheet. And then finally, that link to the all-in-one simulator invaluable. Screw around with that if you haven't already. And for those of you that generally speaking, I'm going to tell you that the all-in-one works best on your primary residence for two reasons. One, it's your primary that has the highest value, which is going to give you the highest limit. And second, you have 80% leverage on the owner occupied than you do 70 on your rental property. And before you say, well, I've got a 2.25% interest rate, then you don't understand conceptually what this is and how the math works. I run that simulator, and the simulator will dispel any of that. And maybe it turns out if you put the input correctly, maybe the simulator confirms your bias and says, yeah, your 2.25 or 2.5 rate is better than the all-in-one. It'll be very, very clear on that results page if you input correctly. But I will tell you guys, more often than not, when I run those together with my clients, the all-in-one smokes 2.5% interest rates, believe it or not, because it isn't about the rate. It's about velocity of money. As a quick example, this is the one, and it's actually in that FAQ. This is the one that I give most often. This helps people connect some of the dots, which, by the way, the all-in-one is complicated. Okay. If you've heard me talk about it, you've heard me say that I struggled. It took me a couple of weeks of looking at it every day. And I am in finance before I was really, the light bulb was like, oh, I get it. So you're going to need to take your time. But the example that I give in comparing, interest rates, if you're going to be psychologically focused on an interest rate, here's what you need to understand. Take two mortgages, a 30-year fixed and a 15-year fixed. A 30-year is 360 months, okay? 15-year is 180 months. Both of them start at $400,000. All right, and look this up. Get an amortization table and actually check my math. Okay, I know that it's right. I've already done it. You locked a 30-year at 4% versus the 15-year at 7%. Without exception, everybody runs to that 4% 30-year because they have a psychological break or cap about rate. They want the 4%. When you run the math, because it's taking you twice as long, the amortization, it's closed-ended amortization, twice as long, you will pay $40,000 more in interest on a 4% 30-year fixed than a 7% 15-year fixed. And while I know that those are not the same as a HELOC, that kind of helps people connect the dot. It's the velocity of money, because that 15-year paid off in half the time, even though it was at 7, you're going to pay less interest. Similar concept to the all-in-one. You are now in charge with how much interest accrual can start on, right? You know how much interest is going to be accrued because of how much depository you have in there, and all the other variables related to your circumstances. So forget about rate, okay? If you really want to save interest and you want the flexibility of having an open-ended line of credit, this is no sales pitch, you guys. If I qualified, I would have the all-in-one. I used to have the all-in-one. There is no better loan for the right individual. Like I said, especially investors. Do the math. It'll tell you. And try to get your head outside of your 2.5% 30-year fixed mortgage that you got in 21. It's if you can't access your equity, it's not serving. If you can get a second lien HELOC, fine. The all-in-one, I can almost guarantee for a lot of people will beat the 2.5% interest rate by interest savings. You save more with the all-in-one and have the open-ended flexibility of this line of credit for 30 years. All right, I'll shut up about the all-in-one. What else we got, Caeli?
All right, here, let's see. So, is there a minimum withdrawal for the all-in-one? So
Yes.
yes. Okay.
The minimum draw is 100,000. That's not to say that you don't have to take 100,000 in cash. If you had a free and clear property, then it would be applicable. You got to take 100 grand. Now you can put it back afterwards, but the minimum draw is 100,000. If we're paying off an existing lien that's 102,000, that's what you owe, then you've already hit the minimum draw. Okay, so it's not over and above what you owe. Just that initial minimum draw has to be 100 grand, and it is inclusive of what you already owe. Doesn't have to be in addition to.
Awesome. All right. So any advice for someone looking to expand their rental portfolio through buying tax delinquent deeds? Do any financing restrictions come to mind or common pitfalls pursuing this approach?
Tax delinquent deeds. No. As long as they're habitable, I mean, for our purposes, depending on what bucket of loan product you fall into, conventional or non-QM or whatever, it shouldn't make any difference to us. Obviously, the taxes have to be current at closing. But no, I can't think of anything that would preclude you or prohibit you in accessing loans to secure or purchase properties where the taxes are delinquent. Because remember, they have to be paid one way or another, however that's going to happen by you or some means of release. I don't know how that might end up shaking out, but a tax lien, judgment, collection, none of those are going to be able to be left on title because any of those government liens are going to be always take first lien position, and there is no lender that's going to take second lien position behind a tax lien. So those will have to be taken care of at closing. But otherwise, no restrictions that I'm aware of.
Perfect. And Xavier asks, would a second home, a vacation home in Texas, considered owner occupied for the all-in-one?
Very good question. I feel like I should know the answer to that. I'm going to say, I don't think so. I think it's only the owner occupied. And I just, you know what? Ask me another question, Carly, and I'm going to pull up because I think I just had this question with Aaron who, hold on.
Yeah, no problem. Let's see. Jeffrey, are you able to unmute yourself? We've been trying. I mean, let's try again. But another question while you're looking at that, let's see here. Oh, can you have more than one all-in-one? Danielle asks.
Hi, Danielle. Hi, DJ. I'll get to that in just a second. So the answer to the question about the second home and investment properties are treated the same. So you're good to go there. It just cannot be an owner occupied. Now, there is a homestead rule with the all-in-one. So if you're doing a second home or an investment property in the state of Texas, those are allowed. You have to have another property somewhere else in the country that we would consider then a homestead. If you are a renter, for example, and this would be your first purchase, you would not be able to qualify because you can't, there's no other homestead exemption property that we could use otherwise. But second home in and of itself is perfectly fine. It's just that primary residence. DJ, this is a good question. And then maybe we'll cap it there unless there's a bunch more, Carly. Can you have more than one all-in-one? The answer is yes. Guidelines say you can have up to 3. You can have one primary, one rental, one second home. The question really, though, is should you have more than one? And it's going to depend on the individual's depository income and what their residual income is. And that's just a fancy way of saying what's left over at the end of the month, right? If you make $10,000 a month, what is left over? That's your residual income. If your bills all in down to a stick of gum or $9 grand, then your residual is 1,000 or 10%. So the answer to your question is, yeah, you can have more than one, but remember the all-in-one is based on what your depository income is and what you have left over. If you're a very high wage earner and you have a lot of discretionary income, it may make sense to have more than one all-in-one, but otherwise you're going to be separating your pool of deposits and leftover against 2 properties or against 2 loans there, and it could defeat the purpose of one or the other. So I would say that running that simulator, so do it all in on one, and then take half or a third or 3/4 or whatever it is of those deposits and leave it there, and then try it again, a second simulation with the difference that you took out or that you left out, if that makes sense, DJ. And if you want, we can do it together. We'll get on the
Okay,
Teams call and do it together.
Okay, that makes sense.
Yeah, good question.
Thank you.
You're welcome.
All right, perfect. So we could probably end it here with this last question by Rich. Jeffrey, I'm sending you a different email so we can get you on with Caeli to answer those questions. So sorry, your mic's not working. So Rich asks, what's my best HELOC option if I own an investment property in Texas? All-in-one is not allowed, right?
If it's an investment property, all-in-one is allowed. The only limitation to Texas and the all-in-one is going to be an owner occupied, but if that's your only property, Rick, I think you said Rick, if that's your only property, then you can't get an all-in-one because you have to have one other property somewhere that we will consider. And I'm not even sure I understand the rule, to be honest. There's got to be a second property or whatever as a homestead that we will consider as a homestead in order to get the non-owner occupied in Texas. So if it's your only property, owner occupied or rental, whatever, if you don't have any other property, this is the only one, and let's say you rent as your primary housing expense, it will be a problem to get that done. Otherwise, investment all-in-one Texas is allowed. Sweet. This was good. In fact, this may have been my favorite so far, where just kind of off the cuff and answer your guys' questions. This is excellent. I hope you guys got something out of it. Carly, we'll have some good sound bites on this that we can use for some social media. We get those to Avery and sorry, Jeff, I'll call you, buddy. Okay, we'll talk one-on-one. It might not be today, but I'll make a note. In fact, Carly, will you tell Vonna to put Jeff on my schedule?
Yes.
Okay, guess what? So ridgelendinggroup.com, info@ridgelendinggroup.com. Look at that cute guy. I see somebody. Look at that cute face. Hey, buddy.
Oh, wow, now it works.
There he is. Oh, Jeff. Okay, how are you?
Pretty good.
Um,
You got it?
All right, let's go. Let's do it. If you guys want to hang out, if you guys are still all with me, let's wait for Jeff.
All right.
I'm ready
Okay,
for
I'm
it.
sorry I lost you there for a second. Okay, so my thing is, you know, I bought the fourplex here recently.
Mhm.
I was looking to do the all-in-one. I was
Right.
also looking at this first payment I'm getting ready to make. If I drop, 60K on it, I'm saving like a $500,000 in interest.
You'll never
But
have
if
that loan long enough, Jeff. That's a waste of your money, man.
it is okay,
Yes.
because I'm really wanting to put the HELOC on that property to help me move forward with everything. So I'm
Okay.
trying to get it paid off as quickly as possible. But because the way, but I have a lot more cash that I could dump on a HELOC,
Right.
as long as I got access to it.
Right.
Versus with a mortgage, I don't have access to it.
Right. So can I give I won't go into any specific detail, Jeff. Can I give a little bit of your background?
For sure, any
Okay.
detail you want to give, I'm fine with.
Okay. So Jeff, we just closed on a fourplex. He was able to do a house hack as his primary residence. Jeff is a high wage earner, but Jeff is self-employed. So like me, Jeff cannot show the taxes necessary to qualify for more conventional loans, and certainly the all-in-one. The all-in-one, by the way, I didn't get into this, is the hardest underwrite that there is. It's brain damage times a lot. So anybody that's going to get into the all-in-one, just be prepared. You're going to lose a few days, weeks, months from your overall life cycle. Okay, I warned you, but it's worth it. It's worth it. So in Jeff's case, we cannot show the last 2 years of tax returns to get the debt to income ratio where it needs to be, but he makes a ton in deposit, right? He's a perfect candidate for it, but for qualifying purposes, he's just not there yet. So he's got this cash that he wants to be able to throw into this closed-ended 30-year fixed mortgage that we have. But in doing that, we're not going to have that loan long enough. At some point, we're going to be refinancing in the next year, 2 years, rates are coming down, et cetera. He will be tying up that 60 grand for nothing, right? He can invest it somewhere else and make some kind of a return in an Ally savings account. I think he can make 3% or something. It's not going to serve his purposes. So what we need to do in your case, Jeff, we've got to get those 23 drafts. What's the status of that?
I've still been dragging along on that.
Okay.
Yeah.
We need his 23 draft tax returns, which is another good reminder, guys. We're in a specific special time of the year. If anybody is intent on getting financing for 2024 and you feel like you may be on the edge, or you purchased a bunch of properties last year, or debt to income ratios and all in question, do not file 23 until you send us the draft tax return so that we can run the pre-formulated calculation and then plug it into your variables and say, okay, this looks great, file. Or, Jeff, we got to fix this up. We got to do this, this, and this, and get your debt to income ratio down. It may sound like magic sauce, you guys, but the definitions are very well defined within the guidelines that we have to adhere to. We know them like the back of our hands. So that's why we want the draft. We'll look at it the way it's written now, and then we'll be able to provide that very specific advice that says, you need to do this, this, or this in order to get that. And that's one of our great value adds. So in your case, I think we're on track. We just need that draft return. I know 23 was a better year for you. Once we can get that DTI on paper, because for Jeff, we did a bank statement loan, right? We were able to take bank statements and the deposits, high wage earner. He's just not showing it on that tax return yet. And sometimes, and this may not be applicable to Jeff, but sometimes you're going to end up having to choose for, again, us self-employed people, whether or not we want to pay a little bit more in taxes or qualify for the loan. Right. It sometimes comes down to one or the other. Anyway, am I helpful? Did I answer you? I need that draft, man.
Yeah, I know that. Where I guess I'm just struggling is that much interest. If I can't move forward with another property at the moment,
Why
or
can't
I'm
you?
not finding it. I'm just not finding.
Okay.
Well, it's not that I'm not finding it. I don't have the 90 to 100K to put down on another property, but I have this 60. So I'm kind of struggling. Like I can't find what I need. So should I knock off all this interest so that I have more equity in this property when I do refinance it?
Well, when you say
So
knock off all this interest, yeah, by paying that 60 grand and plunking it down on this 30-year closed-ended mortgage, you'll save interest over 30 years, but your
right,
payment isn't going to change. You've just
right,
accelerated the payoff date. We're going to refinance that thing well before that's going to even come into play. The first 10 years of your mortgage is 99% interest,
I
right?
know that's what I was trying to knock off since you
Right,
know, because I don't the amount of it is every month doesn't bother me because it's a cash flow already.
right.
So
So I think that you're looking at it from a perspective that you think it's going to be instantaneous when you put that in there, and that's not how it's going to work. When you throw it in there, yes, you'll be saving interest over the big long, but I'll bet you that timeline is probably closer to year 12. I
okay,
mean, I can run it. In fact, there's Carly, would you do me another favor and put on my schedule to work out an amortization table for Jeff? And what it'll look like, Jeff, is it'll have all your variables in there, and I'm going to throw a chunk of 60 grand in there, and then you'll be able to see month by month when that recapture of interest. But in the meantime, if it's even 5, 6, 7, 10 years down the road, the way I expect it to come out when we do the math, you've
right,
locked up 60 grand, right?
right,
That you might be able to do something with. Otherwise, even if it is just a simple interest bearing something, right? That's
all right.
easily accessible. I don't think that that's the best use of that 60 grand in the meantime. What about finding a smaller price property that the 60,000 does make a
Well,
difference
I
for?
can't find anything but duplexes, and I want to go 4 or bigger, and I can't go
Okay,
over 4 without being commercial loan. So
right.
I'm kind of stuck in that spot.
And
So
what market are you looking in? Exclusively your backyard, right?
yeah, for the most part. But I mean,
Okay.
I could be anywhere because I'm in different state every week, so that doesn't really concern me.
I may say, look, let's look outside of your backyard and see, because I mean, I think 60,000 is probably more than sufficient to find. Okay, 2 unit, yeah, maybe a 4 unit. What is that? What's that purchase price at 60% down, 25%? Hold on.
I mean, I got
250-ish.
lucky when I found the one I got for 4 because I can't find them for less than 5, even
Yeah.
right next door. But the appraisals aren't coming up at 5, so yeah.
I would look in Oklahoma. I would look in Indiana, Missouri. What state are you in?
I'm in Missouri right now. My home state's Kentucky, so
The
I'm
property was in
touching.
Kentucky? Okay.
Yeah,
Maybe Texas. But
okay,
250 is going to be, I mean, if you did find something, 250 is going to be that threshold to keep within that 60,000 out of pocket
right.
expense. Otherwise, that tax return
All
over
right.
to me, and we'll have some things to discuss.
Okay, sounds. Yeah, I always file an extension, so I'm always
Me
late on
too.
that. So,
Me too.
yeah. All right.
11:59 p.m. October 15th is when you'll see my timestamp on my filed tax return.
Yeah. All
Yeah.
right.
Yeah.
Sounds good. Everybody
All
have a
right,
great
Jeff.
day.
All right,
Thank
you
you.
too. Thanks. See
Bye.
ya. Anything else pressing, Carly, that we want to cover? Okay. You guys, this was great. Thank you for joining me and us, and Carly, thank you, my dear. So when's the next one? What are we expecting?
That'll be given to you guys through email. We don't have the date yet, but sometime in April, of course, next month. And just pay attention to that email coming over, and we hope to see you there.
Thank you, dear. Okay, guys. See you soon. We're on standby if you need us. You know how to contact us. Bye-bye.